So today, we're diving into understanding risk and its importance in supply chains. Risk is essentially any potential event that could disrupt your operations and lead to negative outcomes. Now let's break this down further so it makes sense why risk management is crucial. First off, every business faces risks. Some are common, like supplier delays or quality issues, while others might be unique based on the industry you're in. The key here is identifying these potential risks early on. Once identified, we can assess their likelihood and impact on your operations. This helps prioritize which risks need immediate attention. Now let's talk about why risk management is so important for supply chains specifically. A well-managed supply chain means efficient delivery of products to customers, but any disruption can lead to delays or shortages that directly affect customer satisfaction. By managing these risks effectively, you're ensuring smoother operations and better preparedness for unexpected events. Another aspect to consider is the financial impact. High-ticket items can be especially sensitive when it comes to disruptions because they often have a significant value attached to them. Managing these types of risks carefully helps keep your finances in check and prevents potential losses. Now let's not forget about regulatory compliance too. Depending on where you operate, there might be specific laws or guidelines that need to be followed. Non-compliance can lead to hefty fines or legal troubles, which could really hurt your business. So risk management here isn't just about protecting your supply chain, but also ensuring you stay within the law. All right, so by now we've covered why managing risks in supply chains is critical for any business. It ensures smooth operations, protects against financial losses, and helps maintain compliance with regulations. But remember, risk management is an ongoing process. You'll need to continually monitor your supply chain for new potential risks as things change over time. So there you have it. Understanding the importance of risk in your supply chains can help you better manage uncertainties and keep your business running smoothly. Let's dive into understanding the risks present in various stages of a supply chain. Imagine you're building your dream home from scratch. There are so many steps involved, right? From selecting materials to hiring contractors to finally moving in, each phase comes with its unique challenges and potential hiccups. It's very similar when it comes to managing a supply chain. There are several stages, each of which can present specific risks that could disrupt the smooth flow of goods from manufacture to delivery. Let's start at the beginning, procurement. This is where you source your raw materials or components for production. Risks here include dealing with high-ticket items that might be prone to price volatility due to market fluctuations, geopolitical tensions, or natural disasters affecting suppliers. Additionally, there's always the risk of quality issues if the supplier isn't reliable. Then we move on to manufacturing, where you bring those raw materials together to create your product. Risks in this stage can include production delays caused by equipment failures, labor shortages, or compliance issues with safety and environmental regulations. There's also the challenge of managing inventory levels so that there's enough stock but not too much that it ties up capital. Next is warehousing. This is where products are stored before they're ready for distribution. Risks here might include damage from handling errors, storage conditions impacting product quality, or theft. It's crucial to have robust security measures and regular inventory checks to mitigate these risks. Then comes transportation. Getting the goods from point A to B involves dealing with logistics providers, navigating through regulatory environments, and managing different modes of transport such as road, rail, sea, or air. Risks here can include delays due to weather conditions, strikes, or inefficient route planning, all of which could significantly impact delivery times. Finally, there's the sales stage, where products are sold directly to customers or through retailers. Here, risks might include issues with demand forecasting, leading to either stockouts or overstocking. Additionally, managing relationships with retail partners can be tricky. They may have their own logistics challenges that affect how and when your product gets displayed. To wrap up, Each stage of the supply chain has its unique set of risks from procurement through transportation and sales. It's essential for managers to anticipate these challenges proactively by developing contingency plans and collaborating closely with suppliers, manufacturers, carriers, and retailers. By doing so, they can ensure that disruptions are minimized, allowing for smoother operations and happier customers. That's it for our overview on supply chain risks today. Let's dive into understanding market risks and their impact on business performance today. Picture yourself standing at a crossroads where every decision you make could lead to success or failure. That's what it feels like managing your business in an ever-changing market environment. First off, we need to understand what market risk is all about. It refers to the potential for loss due to fluctuations in market conditions such as interest rates, exchange rates, commodity prices, and stock prices. These factors can impact a company's earnings, asset values, or cash flows significantly. For example, imagine you run a high-ticket item retail store. If there's a sudden increase in import duties, the cost of your goods goes up dramatically. This could mean less profit unless you pass it on to customers through higher prices, which might reduce sales if they aren't willing to pay more for similar products elsewhere. Another aspect is operational risk. This includes everything from supply chain disruptions to regulatory changes that can affect how businesses operate and deliver their services or products. For instance, a sudden government regulation requiring all products to be eco-friendly could force you to change suppliers or production methods, which might initially increase costs before paying off in the long run. Then, there's financial risk, which involves managing your company's finances effectively amidst market volatility. This can include managing cash flow, debt levels, and investment portfolios wisely. Poor management here can lead to liquidity issues or bankruptcy if not handled properly. Understanding these risks is crucial because they directly impact business performance. For example, if you're a small tech startup competing with giants like Google or Apple, every move needs to be carefully calculated to stand out and gain market share without getting swamped by financial pressures. So, how do businesses mitigate these risks? One approach is diversification, spreading investments across various assets to reduce the impact of any single asset's poor performance. Another strategy involves hedging with derivatives like futures or options contracts to lock in prices for commodities, currencies, or interest rates, protecting against unfavorable market movements. Moreover, staying informed about market trends and economic indicators helps businesses anticipate changes early and adapt their strategies accordingly. For instance, if inflation is on the rise, companies might need to increase prices sooner than planned or look for cost-saving measures to maintain profitability. In conclusion, managing market risks effectively is key to sustaining business performance amidst unpredictable environments. By understanding these risks and implementing robust risk management strategies, businesses can navigate through challenges smoothly and capitalize on opportunities efficiently. Let's dive into today's topic: operational risks, including supplier failure and quality issues. Now, these topics are crucial because they directly impact how smoothly your business runs day in and day out. When it comes to suppliers, think of them like the lifeblood of your operations. If something goes wrong with a key supplier, it can bring everything to a grinding halt. First up, let's talk about supplier failure. This could be anything from delayed deliveries to complete stoppage due to supply chain disruptions. It's like when you're cooking and suddenly realize you're out of an essential ingredient. The recipe stops making sense, right? That's why it's important to have backup suppliers or stockpile critical materials whenever possible. Next up is quality issues. This happens when the goods or services from your supplier don't meet your standards. Picture this: you order high-ticket items expecting top-notch quality, but end up with subpar products that disappoint customers. It not only affects customer satisfaction, but can also tarnish your brand reputation and lead to costly returns. So how do we tackle these risks? Well, the first step is to conduct thorough supplier evaluations before partnering with them. Look at their track record, reliability, financial stability, and quality control measures. This way, you're setting yourself up for success by choosing reliable suppliers from the get-go. Another strategy is implementing robust monitoring systems. Regular audits or inspections can help catch potential issues early on, giving you time to address them before they become major problems. It's like checking your tires while driving instead of only after a flat happens. Lastly, always have contingency plans ready for supplier failure or quality drops. This could mean identifying alternative suppliers quickly or having extra stock on hand. Being prepared means less panic when things go awry and smoother operations overall. In summary, managing operational risks around supplier failure and quality issues is all about preparation and vigilance. By doing your due diligence upfront and maintaining ongoing oversight, you can significantly reduce disruptions to your business operations and keep everything running smoothly. That's it for today's lesson on managing supplier-related risks. I hope this helps you navigate these challenges with more confidence. All right, everyone, let's dive into today's topic: quantitative methods for assessing risk in the supply chain. Now, you might be thinking, why do we even need to assess risks in our supply chains? Well, it's simple. Every link in your chain can introduce potential vulnerabilities that could disrupt operations and impact profits. So, knowing how to measure these risks accurately is key. Let's start with some basic concepts first. When assessing risk quantitatively, we're essentially trying to assign numerical values to the likelihood of an event happening and its impact on our business. This helps us make more informed decisions about where to focus our efforts for improvement. There are several methods we can use here: probability distributions, Monte Carlo simulations, and decision trees being among them. Probability distributions give us a range of possible outcomes along with their probabilities. For instance, if you're dealing with high-ticket items that are prone to damage during transit, you might model the likelihood of those damages occurring. Monte Carlo simulation takes this further by running numerous scenarios based on random sampling within our defined probability ranges. This gives us a better understanding of risk exposure over time and helps identify potential bottlenecks or pinch points in the supply chain. Decision trees are another handy tool. They visually represent decisions and their possible consequences, including chance events along each branch. These can be particularly useful when weighing the pros and cons of different mitigation strategies. Now, let's talk about some specific tools used for quantitative assessment: Valuatrisk VAR and Conditional Valuatrisk CVAR. VAR measures the maximum potential loss over a given period with a certain confidence level. CVAR goes one step further, accounting for losses beyond the VAR threshold. Both are great for identifying high-risk areas that need immediate attention. Lastly, don't forget about using historical data and predictive analytics to forecast future risks more accurately. By analyzing past disruptions and their impacts, we can make smarter decisions moving forward. In conclusion, by adopting these quantitative methods, you're better equipped to understand where your supply chain is most vulnerable and take proactive steps to mitigate those risks. It's all about turning raw numbers into actionable insights that help keep your operations running smoothly and efficiently. That wraps up our discussion on quantitative methods for assessing risk in the supply chain. Thanks for joining me today. Let's dive into qualitative approaches to evaluating potential risks. Understanding these methods will give you a clearer picture of what could go wrong in your project or business venture. Qualitative risk assessment is all about identifying those high-priority risks that might not be easily quantifiable, but are incredibly important to manage. First off, we have the brainstorming method, where a team sits down and discusses potential risks from every angle. It's like getting a bunch of minds together to think through all scenarios, pooling their expertise and experience to uncover hidden dangers. This isn't just about listing out things that could go wrong. It's really about understanding why they might happen and how significant each one is. Next up, we have the Delphi technique. Here, experts anonymously contribute their thoughts on what risks exist without influencing each other's opinions directly. It's a bit like crowdsourcing, but with trusted professionals. Through several rounds of questioning and feedback, you narrow down to a consensus on which risks are most concerning. This helps in getting diverse viewpoints while avoiding groupthink. Then we have the risk matrix or heat map approach. You plot out risks based on their likelihood and impact using a grid-like chart. High-impact, low-probability events might be highlighted differently from low-impact, high-probability ones. It gives you a visual tool to quickly see where your focus should lie when managing these risks. Another qualitative method is the SWOT analysis, which stands for strengths, weaknesses, opportunities, and threats. You assess each of these factors in relation to your project or business goal. The threats part here directly addresses potential risks. By identifying internal weaknesses that could lead to risks and external threats from competitors or market conditions, you get a comprehensive view. Lastly, the scenario analysis method involves imagining different future scenarios based on various combinations of risk drivers. It's like playing out hypothetical situations and seeing how each plays out in terms of risk exposure. This helps prepare for unexpected events by thinking through multiple possibilities ahead of time. So there you have it, several qualitative approaches to identifying and evaluating potential risks. Each method has its strengths, but together, they form a robust framework to help you manage uncertainty effectively. So today, we're diving into something really important: developing a comprehensive risk management strategy. Risk management is essentially about identifying potential risks to your project or business and figuring out how to mitigate those risks so they don't derail you completely. Now, let's break this down step by step. First, start with understanding what risks could impact your project or organization. This involves looking at both external factors like market conditions or regulatory changes, as well as internal ones such as staffing issues or process inefficiencies. Once you've identified these risks, assess each one based on its likelihood of occurring and the potential impact it would have if it did happen. Next, develop strategies to address each risk. For high-ticket items, you might decide to implement preventative measures or create contingency plans that could mitigate damage should a risk materialize. For instance, if you're launching a new product and there's a significant market risk involved, perhaps invest in thorough market research before releasing it. Or maybe secure additional funding, just in case initial sales aren't as robust as hoped. Then comes the nitty-gritty of actually putting those strategies into action. This might involve assigning responsibilities to team members or setting up regular check-ins to monitor progress and adjust plans if necessary. Remember, risk management isn't a one-time thing. It's an ongoing process that requires constant vigilance and adaptation. Finally, document everything thoroughly. Keep track of all identified risks, the strategies used to manage them, and any adjustments made along the way. This documentation serves as crucial evidence for compliance purposes and also helps in making future risk assessments more efficient. All right, let's recap. Identify potential risks, assess their likelihood and impact, develop strategies to address those risks, implement those strategies effectively, and document everything meticulously. By following these steps, you'll be better equipped to handle any challenges that come your way. So there you have it, a solid approach to developing a comprehensive risk management strategy. Let's dive into how aligning risk management with business objectives can truly elevate your company's performance and resilience. Risk management isn't just about identifying risks, it's about understanding them in the context of what your organization aims to achieve. So, when you're thinking about projects or initiatives, start by considering your overall business goals. For example, if your company is focused on expanding into new markets, then risk management should consider factors like regulatory compliance and cultural differences that could impact success. By integrating this perspective early in the process, you can develop strategies to mitigate these risks effectively while still achieving your objectives. Now, let's look at another scenario, say, launching a high-ticket product line aimed at boosting revenue. Risk management here might involve assessing market demand, production capabilities, and potential supply chain disruptions. Aligning risk mitigation efforts with business goals ensures that you're not only protecting the company but also positioning it for growth. To do this successfully, start by clearly defining your business objectives. Once these are set, assess how various risks could impact achieving those goals. Use tools like SWOT analysis or risk matrices to pinpoint areas of concern and prioritize them based on their potential impact. Next, develop tailored strategies for each significant risk. For instance, if you're worried about cybersecurity threats impacting a new digital product launch, you might invest in advanced security measures upfront rather than dealing with breaches later. It's also crucial to involve key stakeholders from different departments when planning these strategies. Collaboration ensures that all perspectives are considered and fosters buy-in across the organization for risk mitigation efforts. Regularly review your risk management plans alongside business objectives to ensure alignment as circumstances change or evolve over time. This ongoing process helps keep you agile and responsive in a dynamic business environment. In summary, aligning risk management with business goals is about more than just identifying risks. It's about creating strategies that support the overall mission of your organization while proactively addressing potential threats. By doing this, you're not only safeguarding your company, but also positioning it for sustainable growth and success. Now, go forth and apply these principles in your own work to see how they can enhance both risk management and business performance. Today, we're diving into an exciting topic that's crucial for any business looking to thrive: implementing diversification as a key mitigation technique. Imagine your company is like a garden, where each plant represents a different revenue stream or investment. Diversifying means planting various types of plants, so if one season isn't favorable for certain flowers, others can still bloom beautifully. Now, let's start by understanding what exactly diversification means in the business context. It involves spreading investments across multiple assets or markets to reduce risk and improve returns. Picture it as not putting all your eggs in one basket. This approach helps businesses weather economic storms more effectively since different sectors might perform differently at various times. Let's look at how this works practically. Suppose you have a high-ticket product that's selling well, but the market for similar products is becoming saturated. By diversifying your offerings to include lower-priced items or services in complementary markets, you create additional revenue streams which can help stabilize income and reduce financial risk. Another way to implement diversification is by expanding into new geographic locations. This not only taps into new customer bases, but also mitigates the impact of localized economic downturns or natural disasters that might affect your primary market. For example, if a hurricane hits the coastal region where you primarily operate, having branches in safer areas can help maintain business continuity. Diversification isn't just about spreading out financial risks, though. It's also about seizing growth opportunities. By investing in emerging technologies or markets, businesses can position themselves for future success and innovation. This forward-thinking approach ensures that even if one area doesn't pan out as expected, others might thrive. Now let's talk about the nitty-gritty of implementing diversification successfully. First, it's essential to conduct thorough market research to identify profitable opportunities. Next, allocate resources wisely by investing in areas with high growth potential and manageable risk. Lastly, monitor these new ventures closely so you can make adjustments as needed while learning valuable lessons for future expansions. In conclusion, embracing diversification is like building a sturdy ship that can weather various seas. It helps businesses navigate through economic turbulence more smoothly and positions them to capitalize on diverse opportunities. So whether you're looking to expand your product line, enter new markets, or explore different investment avenues, remember that diversifying is key to long-term success. Thank you for joining me today as we explored the importance of implementing diversification in business strategies. Today, we're diving into an incredibly important topic: building resilient supplier networks to mitigate risks. Imagine your supply chain as a robust ecosystem where every link is strong enough to withstand disruptions, but also flexible enough to adapt when needed. We'll explore how understanding these dynamics can protect your business from potential pitfalls. Let's start by acknowledging that no matter the industry, suppliers are crucial components of any successful company. They provide the raw materials, goods, or services you need to operate smoothly and meet customer demands efficiently. However, relying on a single supplier for critical items exposes your business to significant risks like delays, quality issues, or even complete supply chain breakdowns. To mitigate these risks, it's essential to diversify your network by partnering with multiple suppliers who can provide the same goods or services at similar costs and efficiencies. This diversification acts as a buffer against potential disruptions from any one supplier failing to meet your needs. But building resilient supplier networks isn't just about having more options. It's also about developing strong, long-term relationships based on trust and mutual benefit. When you foster these connections, suppliers are more likely to go above and beyond during challenging times, like providing additional resources or expedited deliveries when needed. Another key aspect is maintaining transparency with your suppliers. Share your business goals and challenges so they can align their strategies accordingly. This collaboration helps anticipate potential issues before they become major problems. For example, if you foresee a high-demand season for your products, you can alert your suppliers early to prepare adequate supplies. Additionally, investing in technology plays a vital role in building resilient supplier networks. Utilize digital platforms and tools that enhance communication, automate processes, and provide real-time visibility into inventory levels and production schedules. This improves efficiency and reduces the risk of human error or miscommunication. Lastly, it's crucial to have contingency plans for various scenarios, such as natural disasters, political unrest, or economic fluctuations. By mapping out potential disruptions and planning responses ahead of time, you can quickly pivot your supplier network to maintain operations during challenging times. In conclusion, building resilient supplier networks involves diversifying partnerships, fostering trust through transparency, leveraging technology for efficiency, and preparing for the unexpected. These strategies not only protect your business from risks, but also enhance its overall resilience and competitiveness in the market. Today, we're diving into an essential aspect of business management: continuous improvement through regular assessment of risks. Picture this: you're driving down a busy highway and suddenly notice your car's tire pressure is low. If you ignore it, you might end up with a flat tire or even worse. But if you regularly check the tires and maintain them, you can avoid those costly breakdowns. It's exactly the same when managing risks in your business. Regular assessments help you identify potential issues early on before they become major headaches. So let's break this down step by step. First off, why is it important to assess risks regularly? Well, think about it like brushing your teeth daily versus waiting until something goes wrong and then rushing to the dentist. By catching problems early through regular checkups, you can address them more easily and prevent bigger issues later on. Next up, how do we actually go about assessing these risks? Start by identifying all areas of your business that could potentially pose a risk. This might include financial health, customer satisfaction, operational efficiency, or even regulatory compliance. Once you've identified these key areas, develop specific metrics to measure them. For instance, tracking high-ticket sales versus returns can give insights into product quality and customer satisfaction. Now comes the fun part: analyzing your data. Look for trends over time and compare performance against benchmarks or previous periods. This helps you spot any red flags early on so you can take actions swiftly before they become major issues. It's like monitoring your blood pressure regularly. If it starts creeping up, you know to make lifestyle changes sooner rather than later. Another crucial aspect is involving stakeholders in this process. Engage with team members from different departments. Their insights and expertise will provide a more comprehensive view of potential risks. Collaboration fosters a culture where everyone's looking out for the bigger picture, not just their immediate responsibilities. Lastly, don't forget to act on what you've learned through these assessments. If certain areas are showing persistent issues despite your efforts, consider implementing new strategies or seeking expert advice. Remember, continuous improvement is an ongoing journey rather than a one-time event. In conclusion, regular risk assessment isn't just about ticking boxes. It's about fostering a proactive mindset in your business. By identifying and addressing potential risks early on, you create a resilient organization capable of adapting to challenges and thriving long-term. Let's dive right into how technology can help us track risks more effectively and report them accurately. Imagine this: you're managing multiple projects all at once, each with its own set of potential risks. It's like herding cats. Some are high-ticket items that could really knock the project off course, while others might be minor irritants, but still worth keeping an eye on. Now, technology offers us tools to make sense of this chaos. For example, a risk management software can help you visualize all these risks in one place, making it easier to see which ones need immediate attention and which ones are ticking along nicely. It's like having a dashboard for your project's health, where everything is color-coded. Green means go, yellow warns us something might be off track, red tells us we've got a serious issue that needs fixing right now. But wait, there's more. With these tools, you can also set up alerts so you're notified the moment anything changes. Think of it like getting a text message when someone tags you in a post on social media. Only this time, it's telling you about a risk that just popped up or was resolved. No more wasting hours sifting through emails to find updates, and don't forget about reporting. With technology, generating reports becomes as simple as pushing a button. You can export data into Excel sheets or even create visual charts and graphs to show how risks are being managed over time. It's perfect for those board meetings where you need to present the nitty-gritty details without overwhelming everyone. So there you have it. By leveraging technology, we're not just tracking risks more efficiently, we're also improving our reporting capabilities so stakeholders can see exactly what's happening in real time. This way, decision-making becomes a lot smoother because everyone is on the same page, seeing the exact picture of project health and risk management. In conclusion, using these tools isn't just about making your life easier, it's about ensuring that risks are managed proactively and effectively, leading to more successful projects overall. Thank you all for joining me on this journey through managing risks effectively within supply chains. Over these past weeks, we've covered a lot of ground together, from understanding risk and its importance to diving deep into different types of risks like market instability and operational challenges. We explored how quantitative methods can help us assess these risks accurately while also learning qualitative approaches for evaluating potential threats. We then moved on to developing comprehensive strategies that align with your business goals and objectives, emphasizing the importance of diversification as a key technique in mitigating risk. Building resilient supplier networks was another crucial topic we discussed extensively. But it doesn't stop there. We talked about the continuous improvement aspect through regular assessments and how leveraging technology can enhance our ability to track and report on risks effectively. These insights are invaluable, providing you with practical tools to manage uncertainties in your supply chain more confidently. The most important takeaways from this course are recognizing that risk management is an ongoing process requiring constant vigilance and adaptation. It's about making proactive decisions rather than reactive ones, and understanding that every stage of the supply chain has its unique set of risks. By diversifying suppliers and investing in robust monitoring systems, you can build resilience against disruptions. I hope this course has equipped you with the knowledge to identify potential risks early on and take steps to mitigate them effectively. Remember, applying what you've learned is key to success. Whether it's implementing a new risk management strategy or reviewing existing ones, these lessons will serve as a foundation for better decision-making in your supply chain operations. As we close this session, I wish each of you all the best in your future endeavors. May you continue to excel and thrive by managing risks wisely. Don't hesitate to reach out if you have any questions or need further guidance. Additionally, I would love to hear from you about how this course has helped you or any feedback you may have. Thank you once again for being part of this learning journey with me.